There we go.
Nailed it.
Okay. So we're down 95 basis points. Thank you for letting me know that. We're down 95 basis points for the day. That's a bad day. So essentially, if you look at the candlestick charts, we've got 3 days of just a big waterfall of a drop in the bond market. We watched the 10-year now go over 3.25, which I thought was going to be the ceiling. We're now way above that. The reason for this, guys, is the inflation numbers that came out last week on the CPI, the core inflation rates was at 1% for the month, which was above expectations. So anytime you remember, inflation is the enemy of interest rates. So the Feds are going to really have a really tough time this week. But this drop in the value of the 30-year Fannie Mae 30-year bond will directly relate to the rate sheet. So literally right here, 102.42. Now we're down here to 100.68. We're about 180 basis points now. It was a little bit lower earlier today. So that's about a half in rate higher now than 3 days ago. And when I say 3 days, 3 business days. The stock market is taking a plunge. All of this is on the heels of inflation. The more it costs to ship, the more it costs to produce, the more it costs to do anything, the less the income is for all of these companies that are manufacturing, which brings their revenues down, which hurts their stock. So it's just a domino effect. We are now close to an inverted yield curve. I'll show you what that means right here. The 2-year Treasury is almost similar to the 10-year. 7-year, which is a shorter term, is higher than the 10-year, which is an inverted yield curve. That is a telltale sign of a recession. We're almost the 2-year. We're almost at the 10-year. And once it hits that, it's already hit once, but once it hits that again, that's another sign of the recession. So I've been talking about a recession for a while here. Guys, it's not hard to see when you are fueled by a lot of the nitrous that we've had in our markets for the last 2 years of all of the stimulus and all of the people saving money because they don't have to pay rent and they're getting stimulus checks. All of that fuels the economy, that fuels our markets, has come to a screeching halt, and now it's costing more. So it's like a double-edged sword. So we will hit into a recession, and I'm going to kind of talk about the positives that we can take out of this. But right now, the average 30-year fixed, as of Friday, the average 30-year fixed was at 5.85 with points. So we were at 6% on Friday with points. Now we're higher than that because this is based on last week's numbers for the average. We're probably close to 6.25 on a 30-year fixed. A little shocking, but we'll go over some strategies on kind of what we can do for that. But I want to get into a little bit about what this market, what we can talk about with our customers as far as the supply and demand, because this is really interesting. Yes, the rates are higher, but let's look at the supply and demand to really see where we're going as a market. And I think this is going to be really interesting for you to see. So I'm going to share this over here. So I've got this on a different screen. So if I look to the left, I apologize here, but this is the housing supply, kind of what's going on with housing. It's really interesting. So let's just jump right in now. This is housing demand. So when we talk about what is the demand on housing, supply and demand is very, very important to the volume of activity we have in our markets. So housing demand, household formations, what that means is if there's a couple that is getting married and creating a new household formation, a new family, and they've never owned before, but they're now creating a new family household, that's what household formations are. It's not somebody selling one home to get another. It's a brand new family acquiring a home for the first time. So what are those household formations? It's based on the population growth. It's based on new families hitting the market. So if you look here, we are at 1.41 million. Now, the average is actually below, we're above average for household formations. So this is a good thing for the amount of families that are in need. So here's where we are right now, and here's where the average is. So we're still above average for the amount of household formations that are being created every day. And this is by month, but this is a sign that housing is needed. There's a tremendous need for housing. This big up and down here, this was COVID. We saw the huge spike, then it went down, downward, and people were hunkering around. So this is the anomaly. But if you look, the average here, we're in a good position for the amount of people that are needing housing. Now, this is going to be any type of households being created, right? So now let's look at the new house supply. This is a little complicated, so bear with me for a moment here. Housing starts was at 1.75 million. That's homes that are being started to be built. So that doesn't mean they're available right now. That means the shovel's in the ground. Those are housing starts. Every year there's about a million or so, or I would say about a million that are destroyed. So we need to take into consideration. So 100,000. So 1.6 million are actually the new supply that are coming to the market. You may seem that that's a lot, but that's over the next year or so. That's not all at once. And then when we look at the new housing demand, the household formations are at 1.4 million as of right now. There looks like there's an apparent surplus here of 200,000. However, when you look at those that are actually being completed versus destroyed, we're actually at a deficit of 200,000 right now, based on household formations and what is actually going to be available on new homes being created. So that's new housing supply coming to the market. So also keep in mind that we already are 2 million homes in the hole. So we have a deficit. So we're not catching up. We are still below in the amount of new housing supply coming to the market. And if you look at it even further, here's the inventory and here's the pattern over the last few years. When I say few, it's like 7 or 8 years here. So actually 4 or 5. Look at this pattern. We have a high pattern here. The inventory dips down, then the spring buying season, homes hit the market and then it comes down, homes hit the market and then it comes down, homes hit the market and comes down, homes hit the market and then it comes down. We are in that upswing. So a lot of you will say, yeah, a lot of listings are coming on the market right now. It is normal. It is normal to see that because look at the last season of the spring season here. We saw the same uptick. So it's going to be really interesting to see where this comes down. I think it's going to go above this just because it is a slower market than it was back last year, but we're still way below normal. So that's really a really interesting graph. We're still way below inventory levels, and keep in mind the households being created is higher than normal. So we still have a lot of people that want to buy, but the problem is with interest rates going up, they're pausing, they're pushing that pause button. So let's go into housing inventory, the real story. Current and existing inventory is 1 million, but that does not count those that are under contract. So in reality, you take those that are off the market, that are under contract, there's only 400,000 active inventory right now in the country. And that's on single family homes. So here's the active existing home listings in the United States. Here's back from 2017 compared to now. I mean, the inventory speaks volumes. This will grow as the rates are up. It's inevitable that this will grow. But by no means are we in a position where we were in 2008, where this number was inverted. It was extremely high. So we need to really keep an eye on what's happening with inventory. But right now, inventory is still at an all-time low. I mean, we're at only 33,000 from the lowest it's ever been for inventory. So inventory, that's why we'll continue to see appreciation, but at much, much lower levels. And there's still going to be a lot of cash buyers. And keep in mind, 36% of all homes that are owned out there are free and clear. And there's still a lot of cash buyers out there. So mortgage rates affects about 60% of the market. But there's also that other 38 to 40% that is a cash buyer, that they will go out and buy homes with cash because rents are high, returns are high on rentals, and that market will continue to be strong. Now, all-time low in vacancy rates. We talked a little bit about this before. Basically, what this means is homes that are actually vacant, that are just sitting there with nobody in them. There's no renters in them. They're just vacancies. Back in the boom, in the bust, I should say, in 2005 through 8, in that time period, the number of vacancies was quite high. Look at this number. So we were at an all-time low as far as those homes that are sitting there with nothing, with nobody in them. A lot of people were buying them, letting them sit for 6 months and then selling them because the cost of the mortgage was so much cheaper than what it was appreciating for. That is not happening right now. So very interesting graph on that. So that is my little presentation. I'm going to stop sharing this and go to a different set of items here. Hold on one second as I can figure out how to get rid of this. Stop share. All right. So now we say, okay, now based on what we see for the inventory, like what's next? What can we do as a real estate lending team to really help people in this environment? It really is a strange environment. So some of the things I want to go over is where we are as far as inflation. We talked a little bit about the inflation peaking. A lot of people thought it peaked last month. I told you, be careful. The summer months are where it's going to get kind of ugly because we're replacing low numbers with big numbers. And then we're going to taper off after that into the fall, where we're going to see inflation numbers come down. And that's where I think the interest rates will come down. It is a very unique environment, so we have to really watch this carefully. But we had a 1% increase in inflation just last month alone. That's crazy because typically it's 2 to 3% that we want per year. So 8.6% inflation year over year. Tomorrow is where the producer price index comes in. That's the wholesale inflation. So we'll watch that carefully. And the Feds, they're probably going to increase the Fed funds rate by 75 basis points. That's back on the table for this week. So watch that on Wednesday. It's going to be really, really interesting. And that could be a big market mover. Remember, when the Feds raise the Fed funds rate, that is how much the banks borrow on a 24-hour window. That is not the long-term rates. We want inflation to be brought down. Raising the Fed funds rate will offset inflation. Hopefully, that's why they do this, to bring inflation levels down, and that could help mortgage rates. So when your customers say, oh my gosh, rates are going to go up again this Wednesday, we may see a rally on Wednesday if they go up 75 basis points, because that's when investors say, okay, this may now be the peak. But I think we will see some turbulence this next 2 months with those inflation numbers. But remember, the Fed funds rate going up means that we may see the mortgage bonds rally and the mortgage rates come down if they get a handle on this inflation by raising the short-term interest rates. Remember, 30-year fixed mortgages are long-term mortgages. So short-term rates do not affect long-term. And the inflation numbers is what really affects the long-term rates. And we've all seen inflation numbers. Gosh, gas prices make me sick every time I fill up, but it is what it is. So what do we focus on now? Guys, listings are the key. Right now, you're going to have a lot of buyers that are going to be on the shelves, just waiting for rates to maybe come back down a little bit. It's just going to be a natural thing. So we need to really be focusing on listings. That is going to be the absolute key. Some things to focus on are those people, those customers that you've had in the last 2 to 4 years that have bought investment properties and seen a massive gain. Give them a call, get their temperature, see where they're at, because I think listings are going to be very important. And that's one of the reasons we'll see prices, the number of listings go up, is because of people that have bought and they have a lot of money out there. They're thinking, okay, if I sell now, I'll have a lot of cash and maybe I can reinvest that into the stock market when it hits a low. So there's going to be a little switcheroo of investment strategies going on. So take advantage of that by reaching out to all your customers on the listings and just talking to them about that. Another interesting factor is half of all mortgages right now are under 4%. So there's not going to be the rush to sell your home to buy a home right now at a higher rate. It's that market's going to be very limited. So we need to focus on where the activity is going to be. And that's in the listings and new buyers coming into the market that don't have a current mortgage that's under 4%. So that's the millennials, the younger, some Gen Zs that are out there. We need to focus on the youngers and that generation, because if you have a rate right now, if you already own a home, chances are, if it's a primary residence, you're not going to say, you know what, that home across the street, even though it's a couple $100,000 higher, I want to upgrade now because the mortgage payment will be higher on that one than what they already have. So let's not focus on that. Let's focus on what the positives are and really go from there. There was an interesting survey done by Bankrate. 74% of all millennials that don't own homes right now, their number one goal is still to own their own home. And that's above contributing to the retirement. So I thought that was an interesting stat done by Bankrate. But the only thing right now is affordability. So this next 3 to 4 months is your harvesting time, guys. Plant those seeds with the millennials, because when those rates do drop, it's going to get kind of crazy. Depending on what the rest of the markets are doing, I think it's going to be an interesting time to see those millennials jump back on board. So focus on investors to cash in the gains. Retirees, I'm seeing a lot of customers that I've had that are in the retirement age downsize. Some are utilizing reverse mortgages to buy homes. They're using the big equity gains they have to downsize and use the reverse mortgage as a purchase to buy a home with 0 payments. They still have their taxes and their insurance they have to pay for, but there's no payments on their primary home if they downsize. It's a great strategy for those that are maybe empty nesters or those that are retirees that want to now cash in their gains and downsize. Utilizing that reverse mortgage to help them is a big tool. Another thing I want to talk about is those of you that have properties that are new builds. A lot of them have incentives, and a lot of those incentives are being used to pay for the costs of the mortgage and the closing costs. I highly recommend that you utilize that for if there's some trauma, so to speak, with going under contract on these in the 3s and now they're in the 6s on rates at the time where they're closing. Utilize that to buy down the rate instead of getting out of that deal. You will see people that want to back out of the transactions because rates are now so high and the payment's so high. They have some equity that they've gained from the time they bought that, from the time they're going to close. So utilize those seller credits to buy that rate down as low as they possibly can to cushion that blow, to help qualify if they don't qualify anymore, but to B, to help that payment, because that is a very good tool right now to capitalize on lower rates, even though rates are higher. So I've run some numbers on seller buy downs. You can get upwards of 1.25 better in rate by getting a 3% seller credit. And that helps tremendously on payment. And I've got some really good seller buy down graphs that show, one was on a 750 purchase. Just by doing the rate buy down, it was equivalent to them on the payment, to them buying a home that was $80,000 cheaper because the payment was that much lower. So it was equivalent of going to 750 at the rate of the 5.75 versus it was like 680 or 670 or so as what the equivalent payment would be at the same rate, just by doing the rate buy down by the payment that they were having per month. And again, in this type of environment, payment is key because it's all about the affordability index. So let's keep that in mind. Know that it's a tool to buy down the rate. You can do it. It's pretty significant buy down on payment. You get a lot more bang for your buck spending it on buying the rate down than you do towards putting more money down towards down payment. So I can run those for you as well. And then rents are still high, guys. So on a positive note, buyers will continue to buy properties because the amount, or investors are continuing to buy properties because the amount of rents they're getting is extremely high. So let's just stay positive out there and know that it's a tough environment, but together we can, focus on the positives and really get through this. Even though rates are high, there's ways of getting lower rates. Adjustable rate mortgages are a great tool as well. Do a seller buy down plus an adjustable rate mortgage for the short term for the next 3 to 5 years, maybe a really good way of making the affordability a little bit better. And again, if any of your customers need any of this data, I'm happy to share. This is recorded too, so you can share this with your customers and just take bits and pieces of it yourself and just share that as your own. I don't care. Whatever you guys want to use to help you guys in this market, we are here for you. So I'm going to open up to any questions that you guys may have. There's a few in the chat. Are these based on AZ numbers to country? Those numbers that I was going over are based on the country because that's what everyone else is seeing. If you do it by Arizona, we are a little bit more extreme on the amount of appreciation we've seen. So we're actually a little bit higher on the value increases. But as far as inflation numbers and the numbers of the homes on the market, that is a national. Do you have any asset or summary stats that I can send? to my seller that has a home that isn't moving, even though it's a fabulous home and very marketable. Glad to see. Okay, so yes, Tanya, I can get you some information. I'll give you a call on some different things that we have for you on that. Any other questions on what's happening with rates? I mean, this is going to be a pretty big week for interest rates. So if you do have any questions, I'll leave that wide open.
John, I don't have a question on rates, but inflation never so high as 40 years ago. Nowadays, there's so much more extended credit to people, which I'm assuming people are using at the gas pump particularly. When does the nation or economists know when people are going to be max credited out? Right now, they're still spending because they're not paying for it. When do they foresee that that's it? And now they can't afford anything.
So good question. There's actually some stats that you can Google as well to see the national credit ratios as far as how much people are putting on credit versus like annually. We are up 50% right now compared to last year. The amount of savings, this is a really interesting stat. The amount of savings that is out there, I wrote this down. Let me just pull this up real fast. This is a good, a really good marker on where we are health-wise as far as people's spendings. Where is that stat? Sorry. So the savings rate went from 34% to 4% year over year. So that's the savings rate, the amount of people that are putting away money per month. So that means their actual cash that they have, their extra cash that they would normally invest, is only 4% of people are putting money away right now. So people are really in a more of a tight bind right now. And we know why. Everything's more expensive. Food's more expensive. Cars are more expensive. Gas is more expensive. So yes, the amount of credit being extended is higher. It's actually closer to the normal. It was, believe it or not, that 4% is somewhat normal. That 30% was when free money was out there. When I say free money, like people were getting checks in the mail for stimulus. They were putting that away. They were investing it. A lot of people were investing it in these stocks now that are being clobbered. And if you guys have been watching crypto, it's a bloodbath. I never really understood crypto, so I never invested in it. It was very speculatory because it's not really a tangible product. And there's still so many unknowns with regulation on it. But that really has taken a bloodbath. I think it was down to 23,000. It was above, in November, it was above 60,000. So you see a lot of that money being lost right now, and it's painful. It is painful. But as far as the overall credit, we are at normal rates right now, but I think that will slip down as costs go up. That will be recessionary, and you'll see that because in a normal recession, that always goes up, and that's where we are headed. If a lot of people don't think we're here that already, but if you talk to people on the streets, we are here. The numbers are just not hitting the markets yet. But it is a good time for you guys to really focus on listings though, because there will be more listings hitting for sure. But in a good thing, on a separate note, a lot of people have really, really very reasonable mortgages right now. Back in 2008, they didn't have it. Those rates were changing because a lot of people did really bad adjustable rate mortgages. When I say bad adjustable rate mortgages, they didn't have any caps on how much they could change. So they went from like a 6%, which is the rates back then, to 15% in 1 year. Those were all those subprime adjustable rate mortgages. We have caps on them. So if they did an adjustable rate mortgage, it's not going to be as extreme. But a majority of all loans that are closed, a very high percentage, I would say it was 90 plus, are all fixed rate mortgages, and 50% of them are below 4%. So that's very healthy, that side of the market. It's the new people having that higher rate is kind of a hard pill to swallow. Yeah, I do expect credit issuance and credit cards to be used a lot more than they have been. That is for sure. All right. Well, any other questions with rates and with mortgages? If you guys don't have information on the seller buy down, if you have listings that are sitting on the market, it is a great way to show people how cheap they can get it. Instead of offering $20,000 under asking, put an offer in at full price, but with a $20,000 seller buy down to get a really low rate, you can get a rate still in the 4s if you do it that way. So it's a great way to get into the rates of the past right now. And if you have any scenarios you want me to run for you, I'd be happy to do that individually. All right, guys, well, hang on to your seats. This is going to be a really active month or active week with the feds. And if you need anything, I'm always here and I'll be here to support you. My team will be here whenever you need us. So thank you guys for everything. I'll stay on a little longer if you have any personal questions, any personal scenarios you want to run by me. Happy to